Welcome back. So in this video we will be talking about how to record income, expenses, assets, liability and owner's capital in books of accounting. Well, before we start talking about that, first we have to recall how do we record all these things manually in our general life. Well, we simply take a piece of paper and we start recording all the increases with a positive sign, and we record all the decreases with a negative sign, and after that we calculate the net balance. That is how do we generally record all these things in our general life. That is not how do we record things in accounting, even though there is nothing wrong with that, but we have to move to a more sophisticated method which have been followed by accounting, and this method is known as T-shaped structured, or sometimes it is called ledger or T account. Now let's take a brief look at what is a ledger. So every ledger will have two sides. One side is known as debit while the other is known as credit. As we know that debit means anything that is coming into the business, and credit means that is going out of the business. So all the increases are recorded on the credit side and all the decreases are recorded on the credit side. Everything that is need to be recorded in accounting will always use a separate ledger. Let's say we record income, expenses, cash and three different banks, then we will use a separate ledger for all of them. Now you can see that cash has a separate ledger, income, expenses and as well as the three banks. Now students usually understand debit always mean plus, increases, or credit always mean minus or decreases. Well, it is not a appropriate approach. It is depend on the class of the ledger. It depends on the rule of the ledger. For asset, debit is going to be different, and for liabilities it is different. For owner's capital it is gonna be different. So for every class the assets rule will be different. Now let's learn the debit and credit rule for asset. Let's say we receive 500 dollars. So $500 are coming into our hand, so it will be recorded on the debit side. Now let's suppose that we give $100 to someone, so $100 is going out of the business, so it will be recorded on the credit side. So after deducting 500 into 100, we will get $400 with a positive sign. This positive sign mean we have a balance of 400 which is available, and if there is a negative sign it means that we have a liability that we must have to pay back. Now this credit and debit rule of asset is going to similar to all of these different asset. For cash, bank, property, plant and equipment, motor vehicle, inventory, furniture and fixtures, receivable and prepayments, all of that the rule is going to be similar.